screen, but I'm delighted to introduce this 20th Maxwell Fry Global Memorial Lecture in honor of Professor Maxwell Fry. Max received his PhD in economics at the LSE in 1970, taught at City University of London for 4 years, and in 1974, he joined the Department of Economics at the University of Hawaii before leaving to teach at the University of California, Irvine in 1980. And shortly after this, he accepted an endowed chair as Professor of International Finance here at the Birmingham Business School. Max passed away prematurely in 2000, and we remember him each year at this time. I was reading in the run-up to this a tribute to Max in a special issue of the International Journal of Finance and Economics written by Philip Orestes and our very own Peter Sinclair in 2002. They say that at school at Oundle, Max was renowned for his high spirits, a love of animals, and a rather limited respect for regulations. And I know that as head of college and in these COVID times, I probably shouldn't say this, but I'm instantly warming to him. Maxwell Fry was later a prominent figure in the world of international finance, and his work was widely acclaimed in central banking circles. His contribution was in the field of international development and global finance, and the annual lecture is given each year by an international academic or policymaker on a topic that reflects his interests. Max, I understand, was very well liked by everyone and took a particular interest in helping early career researchers to develop. And those, I'm sure there are some here today who worked with him, I know miss him very much. We're particularly delighted that this evening Celia Fry, Max's widow, is also here to join us. And so with no further ado, I'm going to pass over now to Jane Binner, who will introduce our speaker for this evening.
So thank you very much, Richard Black. It's my pleasure to welcome you and Richard Anderson. I wanted to say a big thank you to you, Richard, for stepping in today, because for the last few years, I've had the privilege of working with Peter Sinclair in the role of running this Maxwell Fry Global Finance Lecture. I'm really sorry that that Peter Sinclair is not with us due to the sudden death of COVID, but this is a lecture that we wish to celebrate the life and work of Maxwell Fry. So thank you, Richard, for stepping in. My relationship with Richard Anderson goes back many years, where our connection is the demand for money. I'm really delighted that Richard can be here today. Richard has a PhD from MIT and a bachelor's degree from the University of Minnesota. Richard joined the Federal Reserve Bank Board of Governors, and from there he worked in the Federal Reserve Bank of St. Louis as Vice President Research for 25 years. Dick had a long and distinguished career in the economics division, developing the adjusted money base and the Federal Reserve Bank of St. Louis monetary services aggregates in collaboration with Barry Jones. I'm delighted that Barry's here today to be with us at this important time. So Richard works in the area of monetary policy, monetary aggregates and econometrics, and is no stranger to Birmingham. Richard first joined me in Aston many years ago, where we ran a conference on measurement error, and has since been a Leverhulme professor in the Sheffield Management School for 2 years, between 2009 and 2011. So without further ado, I'm going to hand you over now to Richard Anderson for central banking in interesting times, the demand for base money. Thank you, Richard.
Thank you, Jane. Now, the technology. Charlotte, can you assist me in sharing my screen?
So I've made you a co-host, Richard. So you should now have a green share screen button at the bottom of your.
I should. Oh, I do. Okay, I'm looking on the wrong window. Okay, let's see if that works correctly. Will that work for everyone?
Yes, thank you. Good.
Introductory slide.
Yep.
That slide's on a on a different monitor to my right, and I don't seem to be able to move the window. So we'll make do. As Professor Black said, this is the 20th Maxwell Fry lecture. I've chosen the title in part based on my experiences 25 years working in the Federal Reserve System, as well as teaching. The phrase "may you live in interesting times," in as much research as I could find, the origin is disputed. Some claim it's an old Chinese slogan, but most often it's attributed to Joseph Chamberlain, the first chancellor at the University of Birmingham, interestingly. The phrase that's often associated with it is say, "may you live in interesting times," is more a curse than a blessing. And my experience as a central banker is that you're always living in interesting times. It's one thing after another. So I initially went to the Federal Reserve Board in 1988. I was teaching at Michigan and went to the Fed to write briefing material for the Open Market Committee, and was quite quickly assigned to work on the savings and loan crisis with the Resolution Trust Corporation. Not quite what I anticipated, but that's one thing after another. As that wound down, Alan Greenspan became very interested in the term structure and why long rates wouldn't fall as he thought they should. And he was searching for some staff to assign to work on that problem. He was also a fan of Rostow and Schwartz's History of British Overseas Lending. So he developed the hypothesis that perhaps it was capital flows into the newly opened countries of Eastern Europe that were holding up long-term international rates. And he looked for a volunteer or a victim to work on that topic, which came to my desk. The upshot of that was a paper that two of us presented in 1990 to a money macro finance conference at the London Business School. Max may have been in attendance at that conference. It would have been of interest to him and about the right time, but I have no idea. As I opened that presentation saying, "There's very much a Coles to Newcastle. Why am I coming to London to talk about British economic history?" But everyone at the conference was very kind. But that's kind of the way it is in central banking. It's one thing after another. Today, I want to talk a bit more about debt loads. I want to put this in. I thought this was kind of interesting. Many people are aware of Richard Sayre's prominent role in monetary economics in the 1950s. And Forrest Cappy quotes him a couple times in his book on the Bank of England. It is probably fair to say, as I put in the lower quote, there's never been a time when there were so many unsettled questions of central banking as there are today. A gross understatement. It may have been true in 1958. It's certainly true today. Of how central banks should behave and how they should. I often used in my teaching, both in money and banking and economic history, I often used examples from Sir John Clavham's History of the Bank of England. And I think the history of the Bank of England is perhaps very important for us. Okay, so Professor Black reviewed quite a bit about Maxwell Fry, and I was asked to do some of the same, so I have, and there'll be some overlap. I don't know if Carolyn is able to join us. His daughter is also an MIT PhD. So in the interest of the Alumni Association, I put in a small call out to her. Said Max is Professor of International Finance at Birmingham and Director of the Bank of England's Center for Central Banking Studies. In another casual connection, as he sat for his bachelor's degree at LSE, he was a classmate of Stanley Fischer, later professor at MIT from 1973 on, coming from Chicago to MIT in 1973. Fischer was very popular with the graduate students, incidentally, and at the end of 1974 academic year, the graduate students voted Fischer a special teaching award. As head of the Graduate Economics Club that year, it was my honor to present Fischer with that award. The world has small intersections everywhere, and not very big, but so it was. As Professor Black noted, Max then seemed to like flying, taught in London, went to Hawaii, then to UC Irvine, a very fine department at the time, strong in international economics, strong in econometrics. Dennis Eigner, a friend of mine, was there for quite a while. In a 2002 festive for Max, Eddie George, governor of the Bank of England, noted that under his direction, the Center for Central Banking Studies at the Bank of England expanded from simply a teaching tool for heads of central banks in developing countries into a genuine forum for central bankers from around the world. And you can, the rest of it is in this festive volume. Eddie George is very complimentary. Max also had the Hubland Norman Fellowship at the Bank of England. My only connection there is that I applied for it and didn't get it. But anyway, the University of Hawaii, where Max taught, I found very interesting, has on their website a collection of commentaries about former faculty members. Not very many universities do that. It's kind of interesting, maybe a sense of presence for the department. And they have this casual comment, most of their pages do, as they wrote, who can forget Max, a British accent, infectious laugh, who came to work in rubber slippers. Now, it is Hawaii. I assume he had Hawaiian shirts to go with the to the rubber slippers. He played the violin. His wife played the cello. They were accomplished musicians. A nice tribute. Now, Fry's research focused on monetary policy in developing countries with two primary themes. One, developing a viable financial system, essential to a market-oriented capitalist economy. As a historian say, when the Bolsheviks took over in Russia, the first thing they did was seize the entire financial system, knowing that without it, the market-oriented economy could not continue. Holding that was essential, and in Max's work, that was an essential part. Another theme is the interaction between fiscal authorities and the central bank. Now, this is not a new theme. It goes back, some people say, as far as economics. But developing it and bringing it forward was important, particularly the roles of deficit spending. We're very much aware of authoritarian governments. As Sir John Hicks said in A Theory of Economic History, sovereigns are always hard up. They're always looking for money, and the deficit spending and pressure on the central bank is a very common theme. Max's book, Money, Interest, and Banking, is still in print. I did read the entire book, and it continues 25 years after the second edition to read very well. It was a very well written and topical book. So my theme today is basically to say that given events of the last 12 years, developed countries, and I'm going to focus on the UK and the US and the United States, face many of the same problems that Max talked about in developing countries, particularly problems of debt overhang and the coordination of fiscal and monetary policy. So, but in Fry's day, it was known as the government budget constraint, has developed in today what is known as the fiscal theory of the price level literature. I'm going to talk about that a little bit. Fiscal policy matters for inflation. Original models of the fiscal theory of the price level many years ago were seen as an alternative to the quantity theory of money. Let's explain price level movements and inflation in terms of fiscal policy. That has died out. That literature's gone. There's much more sophisticated literature now about the interaction between monetary and fiscal policy. We're going to see in a theme, particularly from Chris Sims' work, most explicitly, although it makes sense, that large budget deficits can get out of hand if you continue to borrow each year the money to pay the interest on the previous year's interest. Eventually, the process becomes sustainable only if there are primary surpluses to reduce the debt. It's not a surprise to anyone. The Office for Budget Responsibility in the UK, and I want to give them a call out for doing terrific work. Their reports are very well written, they're very clear, they're very well documented. And they have discussions of this in some of their recent material. Now, one of the puzzles in macroeconomics of the last 12 years has been the enormous expansion in central bank balance sheets without accompanying inflation. And the fiscal theory of the price level can address that issue. There's very little other in macroeconomics that does these days. And we're going to look at a little bit of the history from some previous papers I've done on that topic. Okay, so recent events. Well, we know there was a global financial crisis. At the time, people thought that was a huge economic shock, the biggest shock since the Great Depression, as they say. And then the 2020 COVID pandemic came along, and we have a second major shock, even after we haven't really unwound the policy actions for the first shock. And the two together have put the United States and the UK and some other countries I'm not going to pursue in a rather difficult policy position. So you'd expect savings rates to rise. The economy is shut down. Right? There is a very nice report I found for the UK about distribution of the savings among households. You expect more savings in higher income households. And our basic freshman level macroeconomics would suggest with this very high savings, it's appropriate for the government to step in to take some of that savings as they mobilize the savings in the economy with this type of shock. Here I've put the US and UK budget surpluses and deficits on the chart, different scales, obviously, but again, the effect of the global financial crisis was to worsen the fiscal position in both countries. And then you have the pandemic at the end making things much worse. I think everyone knows that. Debt as a share of GDP, debt measures are difficult. The UK and the ONS and the OBR have much better documentation of exactly what they're including in which debt series than the United States does. This series known as total public debt, more than just ordinary treasury debt. But in both cases, the global financial crisis saw increases in public debt as a share of GDP, which was not subsequently reversed. Maybe it should have been, or it wasn't. And then the pandemic hits, and you have another great increase in this same problem. And we're going to come back and look at both of those in a little more detail. What also should concern macroeconomists and does, and I'll talk a little. The Deputy Governor of the Bank of England last month gave a long public talk on this, is the financing of this deficit by the central bank, something that concerned Max very much in his work. Here we have the asset purchase facility from the Bank of England, rising to about 435 million pounds after the global financial crisis, and then enormous expansion in that facility in the bank's balance sheet with the pandemic. The question is, does this matter? And we're going to try and say a little about that. If the Federal Reserve, some consequences, this goes back to March. I don't take it back further. If you look at total debt held by the public in the Federal Reserve's purchases, into about May, the Federal Reserve had purchased essentially all of the debt that the Treasury had issued since March. Now, these aren't the same issues. The Treasury by law sells the debt in the market. Usually the primary dealers and the Federal Reserve buys at the market. The Federal Reserve has been buying longer maturities. The Treasury has been selling shorter maturities. All of that matters. But the totals are rather startling. And except for the period in the middle, where the Federal Reserve was not buying as aggressively, if you take the latter part of this, the Federal Reserve, as some commentators have noted, some analysts have noted, is buying essentially all of the debt issued by the Treasury in the market. For some people, and particularly some of us older Keynesians or monetarists who remember the inflation of the 60s and 70s, this is concerning. The budget deficit for the last fiscal year in the United States was about $3.5 trillion. It was projected at $1 trillion before the pandemic. You add $2.5 trillion in pandemic spending, you have about $3.5 trillion in the budget deficit, very close to where this line ends. And the Federal Reserve buying about 80% of that debt. Is that worrisome or not? Well, the Bank of England is in somewhat the same quandary, financing large parts of this debt. So, okay, let me talk about a few academic papers. I thought I should put some in. This is supposed to be more or less an academic talk. I originally proposed to Jane to talk about an econometric model of monetary base demand, and Jane said, no, you can't do that. No, it's not appropriate. So, so I have some things that are trying to stay much less technical. One of Fry's last papers with the late Peter Sinclair was in the International Journal of Finance and Economics. And it attempts analytically to explore what we call the government budget constraint in an interesting way. And at the introduction of the paper, late Professor Sinclair has a very nice dedication for him during their period at Birmingham. This paper from 2002 is a follow-on to a 1996 paper about the economics of the European Union and the Euro area. And he says, it is a great honor for me to be able to offer this tribute to the memory of an outstanding economist. Very nice introduction, I thought, and very nice of the editors of the journal to permit it to be included. I'm going to put in a pause for something else from Maxwell. Come back a little bit. Many of us know, if you followed both the global financial crisis and the pandemic, that central banks have been coerced into agents of fiscal policy in another way to run any number of credit easing, credit expansion programs. And Max has this old paper, which as far as I know has never been printed anywhere, The Fiscal Abuse of Central Banks. And I rather like the title of this paper because he lists the activities that basically, when the fiscal authorities don't wish to do them, they push them onto the central bank. And maybe they belong there, maybe they don't. They involve various kinds of financial regulation. We know there's banking regulation, and we know the mission, for example, the Federal Reserve seems to expand. Every time there's an economic problem, the Federal Reserve is handed some new task. Some say because they're a trusted agent in a very partisan Washington, others because people want the activities hidden in the central bank. And then Max continues with his goose analogy, which says it has generally been the case in these developing countries that the central bank becomes a fiscal agent that raises money for the government. And there may be free-range geese. They have very little control that contributes a bit of earnings, their earnings between their assets of government bonds and their liabilities. There are others that with a little coercion can contribute more, and in countries where the central bank becomes the prominent financer of government deficit can contribute quite a bit. So developing countries undermine central banks' independence and hence their monetary policy objectives. I'm not here to suggest that that's true of either the Bank of England or the Federal Reserve, but I'm going to suggest both of them should be concerned about that. Okay, so the Fry and Sinclair paper sets out a two-equation differential equation model to explore how the equilibrium might depend on the government budget constraint. And they impose very reasonable conditions that they want to study the equilibrium where the inflation rate is constant, time derivative inflation is 0, and where the ratio of government debt to GDP is constant, right? Which seems like a place you want to get to. I mean, you could have debt to GDP fall to 0. You could have it explode, and we'll argue that the United States may be on that course now. And having a low stable inflation rate has long been a goal of the central banks. So they're very reasonable equilibrium, and their goal is to examine how this depends on a range of parameters. The simultaneous solution to that system of two differential equations look like. It depends on the growth rate of GDP, the budget surplus, real interest rate, share of the budget deficit financed through the central bank, etc. So fairly straightforward. I'm not going to try and walk through their model, which I'd have to do by just reading the paper. It's a very tightly written paper. Their conclusions are that you can find, positions where you have these equilibriums, but they're fragile. For example, in the picture on the right, you might like to be in the position where you have a modest debt to GDP ratio and a modest inflation rate, but you find you can't stay there. The nature of the system is going to force you into one equilibrium which you might not like. So at some preferred points in between, others are unstable. It's a saddle point, a saddle ridge kind of solution to the differential equations. I don't think many people would attempt that today. These problems are typically not analyzed with those types of tools, but it's a very interesting paper. Next, if we expand on sort of Max's or the profession's interest in fiscal theory of the price level, let me talk a little bit about Chris Sims' 2013 AEA presidential address in San Diego. And he opens with the same concern I have today. Recent expansions of central bank balance sheets and the levels of rich country sovereign debt have made it clear that fiscal policy and monetary policy are intertwined. I know Chris thought that was obvious, but there are a number of people who weren't receptive to his presentation, or particularly to his talk and some of the conversations afterwards. And I'll pick only a couple major points. The real value of a country's debt is the present discounted value of future primary surpluses. One of the things that's happened in recent years, in part because investors were burned by inflation in the past, is that central banks and the fiscal authority are dealing in real securities, either very short-term securities, which are effectively real, or indexed longer-term debt. And the deputy governor, as well as the Office for Budget Responsibility in the UK, both make the point it's no longer possible to inflate away the value of the debt. This is essentially real debt. It's going to have to be paid for in real goods. And the consequence is you're going to have future real government surpluses, primary surpluses, to pay it. Sims, of course, cites Neil Wallace's so-called Modigliani-Miller theorem for macroeconomics. The real value of firm equals the present discounted value of the firm's profits. And Wallace says it's exactly the same. The real value of the country's debt equals the present discounted value of the country's primary surpluses. It's the same problem. And many students in monetary economics have struggled with Wallace's 1981 paper on the ineffectiveness of open market operations. The open market operations have no effect in his model, two-period overlapping generations model, so long as fiscal policy does not move, so long as there's no change in the deficit. And it makes quite good sense, if you think long enough at it, that actions taken by the monetary authority have to affect variables in the economy that are going to affect the fiscal balance. If you impose the constraint that fiscal balance does not change, the open market operations are ineffective at moving the economy because they don't move interest rates and asset prices. And Sims really builds off Wallace's insight. Perhaps I'm more receptive to Sims and Wallace's arguments because I was at Minnesota as an undergraduate with Sergeant Sims, Wallace, and others, and sort of grew up on some of this. But it seems to me exactly right. There are questions, of course, in the modeling about how you're going to do it. So an adverse macroeconomic shock, and here we're talking about the two largest shocks since the Great Depression, the global financial crisis and the 2020 pandemic, require larger future primary surpluses in order to satisfy the conditions of the government budget constraint, Fiscal Theory of the price level. And then Sims continues some of the points that I think everyone knows. Fiscal policy affects the economy. Monetary policy affects them. If fiscal policymakers act to offset induced changes, monetary policy will have no effect. Again, Neil Wallace's 1981 paper, and Sims argues that that result applies more generally, not just within Wallace's very narrow model. Now we know fiscal and monetary policy are connected because we understand policymakers talk to each other and they all issue reports, they all share forecasts. The point here is that even if they didn't do that, through the market itself, through the operation of what we're going to call the government budget constraint, the actions of one policymakers will affect the others. Some will find themselves frustrated in achieving their goals because of the actions of the other policymakers. Now, a more recent paper, there are many of them. This is one I picked because I thought this was a very interesting paper in the Journal of Economic Dynamics and Control. 3 economists from France, a model of fiscal dominance. Fiscal dominance has come back to the fore in discussion due to Carmen Reinhardt at Harvard, who's revived what was a very old conjecture, very old model that Max also concerned about. How do fiscal and monetary authorities deal jointly with problems of high debt ratios and potentially unsustainable public debt growth? And has a major consequence to the 2008 financial crisis was the rise in debt ratios. We saw that. Given strong Keynesian effects, which means consolidation in income, reduction in aggregate demand, governments have been unable or unwilling to reduce the high levels of sovereign debt after the global financial crisis. And as they say, in this context, economic policy debate is brought back to the agenda. What's the interaction between monetary and fiscal policy? Should monetary policy makers seek to rescue the fiscal policy makers, and even will that happen? Financial repression, financial dominance, as I said, Carmen Reinhardt at Harvard has brought this back to the forefront in the discussions. Professor Fry in 1982 has a long survey paper on exactly the same topic. And financial repression, financial dominance means generally that the central bank makes an effort to keep interest rates lower longer than they would in some optimal sense to assist the fiscal authority in carrying their deficit. And they're also considering or permitting the inflation rate to rise higher than they might otherwise based on some cost of inflation criteria, again, to try and assist the fiscal authority. Either it can be done explicitly, as it might be in a developing country, or implicitly through the conflict of objectives in the market. So this is a much more, I would say, a modern paper. Fry and Sinclair set out to explore this equilibrium analytically. Today, you let the computers do the work. You set up a much more complicated model. I just wrote down the core equation in their model. I'm not going to attempt to explain it all. A shortcoming in the model is they don't allow for the central bank to pay interest on M. If M is in currency plus deposits, the central bank, there should be another interest rate in here, another policy tool, and they don't do that. The classic analysis, again, that we saw as undergraduates in Minnesota was Sargent and Wallace's unpleasant monetarist arithmetic, where they play a game. And this is as much Sims summary as anything else, that if the fiscal authority acts first and sets primary deficits and surpluses, what does the monetary authority have to do? How does the monetary authority get trapped into that? If they set a budget policy that's not sustainable, eventually the world explodes, or you get very high inflation, or you get default. And in this paper, the monetary authority is allowed to change the real interest rate and GDP growth. Can it assure solvency of the fiscal authority? What's kind of interesting, if you're familiar with recursive stochastic programming macro models, there's typically a no Ponzi game condition in the model. And if households are allowed to borrow, there's some condition that they can't borrow more than the total discounted value of their entire income. And if they're infinitely lived, there's a transversality condition at the end that enforces that. So there's no Ponzi game. No one lets them borrow more than they can afford to pay back. Interestingly, there's no such thing for governments. Governments are allowed to borrow more than they can reasonably pay back in terms of primary surpluses, and that's an interesting topic for future work. One of the results in the paper is to ask the interesting question about, suppose you look at a few countries in various times, and you ask how far away from sustainability is their budget, given their debt load, and given reasonable assumptions about interest rates and GDP growth, what would be necessary in terms of a primary budget surplus to make the budget pass sustainable? Okay. The table that's in the paper is incorrect. And that's not entirely my discovery. The authors very kindly sent me their data and programs and the output of their programs. And the output is in the upper table, which differs from what ended up in the journal article. I assume it's the typesetting error or transmission error somewhere. But some of the numbers, as they wrote to me in private correspondence, indicate that these are simply not sustainable. You have Japan, where we know the government debt burden to ratio to GDP is about 250%. And to stabilize that ratio would require 8 to 9% of GDP, of a primary surplus equal to about 8 or 9% of GDP. The United States, 9% in 2010. This is coming out of the global financial crisis, very high debt load, which has slowly worked off. So 5.5%, and before the pandemic comes, it's 2.4%. You know, I have not reprogrammed their work, which I intend to do, and I want to extend this a little further. Again, some of the numbers are bothersome because I look at, they say the data come from the World Economic Outlook. I go look there and I don't necessarily find the same debt numbers. And the numbers that are debt in the World Economic Outlook don't match the numbers that are debt in other sources. And it matters. So just the definition and measurement of debt is a problem that requires more discussion. But I think this leaves out the simulations from their model. And this leaves out the pandemic. This is just the hangover from the global financial crisis. And then they go further, going back to what Fry and Sinclair were trying to work on, the difference between the interest rate on debt and the GDP growth. Right? And in most cases, you need to push that differential R minus G into significant negative territory to stabilize what you're doing. So let me go a little faster. I'm falling a little behind. The global financial crisis, we know policy rates for central banks went to zero. With their policy rate close to zero, central banks went into large-scale asset purchases, often called quantitative easing. As Ben Bernanke says, the purchase of assets from the private sector with newly created central bank deposits, promising to reduce risk and term premium and longer-term interest rates and thereby stimulate the economy. And it's not much different, except for the stimulation part, as many developed countries did. So in the panic, we know some countries' assets percent of GDP went from 5 or 6% as high as 20, 22, 20, you know. The Bank of England is the gray line. The Swedes, the European Central Bank, and except for Sweden, they didn't really come down. The economy started recovering and they stayed there. That one, no one wants to raise taxes to reduce these ratios. That's one problem. To the extent this debt is real, you have to grow out of it. You can't inflate it away. This chart comes from a journal article of mine in one of the St. Louis reviews that looks, because of the heading from Zoom on this, I can't read my own titles anymore. showing how the expansion in central bank liabilities, and I call the monetary base, the United States, the UK, country after country, and some were reversed. This is the middle, this is actually the middle of the banking crisis in the mid-90s in Sweden. After the financial crisis, they had a much more modest gain. Inflation didn't accelerate in these countries. The dashed line is a core measure and the other one the headline measure. By traditional macroeconomic views, we would have said, well, there's a global financial crisis here, but you know, later on, when things wound down, we should have unwound all of this, and we didn't. Okay, so the papers referenced here, the November-December St. Louis Federal Reserve Review. You'd like to read something beyond my very fast summary. So they talked just a minute about the pandemic again. We know what's happened to GDP, unemployment, inflation. We know it was a big shock to the economy. As I said before, domestic consumption fell, savings rose. This is UK data. Similar things happened in other countries. Central banks immediately, the Federal Reserve had been increasing their federal funds rate, immediately cut it simply to zero. The Bank of England had been very slowly and reluctantly increasing bank rate up to 75 basis points and immediately cut it back close to zero. But large-scale asset purchases come right back in. So this chart comes from, as I said, the Office of National Statistics. Its debt as a share of GDP, and most news sources, including the BBC, was very concerned about the increase in debt. And I'll note the light lines in here reflect the Bank of England's contribution. That once the bank shifted to seeking to stimulate the economy more beginning in 2016, its contributions to debt. And it's not driving the debt, it's purchasing debt being sold by the fiscal authority. Government borrowing, all the agencies in the UK I just are very candid that the budget from 11 March before the pandemic forecast major increases in borrowing, and the pandemic has only made it worse. Another chart of how the debt relative to GDP increased in the global financial crisis, was not reversed, and has now simply come back and redoubled. I'm going to skip this one. Bank of England, same point I've made earlier. The Bank of England has financed a great deal of the increase in debt by purchasing and putting it on its own balance sheet. Yet the markets don't expect much inflation. 10-year bond rates are low. And it may be the financing of this debt for long periods of time can be done at very little money. Now, this picture comes from the deputy governor's talk in September. He closes with the view that the debt is probably not a problem. This debt overhang's not going to bother us too much because inflation expectations are so stable, not commenting on the fact that they're stable at 3%, not 2%, which is their target, is kind of interesting. There are two recent speeches on the topic. Bertrand Vizage, recently appointed external member of the MPC, and Bren Broadbent, recently appointed deputy governor of the bank, simply re-echo what I've been saying. There were rounds of quantitative easing after the financial crisis. We expected they would be unwound, as they should be. We felt the economy didn't improve, so we simply left them in place. Before the global financial crisis, debt, central bank, Bank of England debt was 12% of government, now it's 26%. There is no clear threshold beyond it's too much, and that's true in the economics research literature. And then he says, well, investors believe the government will do the right thing when the right thing has to be done because we haven't seen sharp increases in interest rates or inflation. Well, there's a little circularity in that. You haven't seen them because you think the authority is going to do the right thing, and the authority thinks they don't have to do anything because the market expectations suggest everything's fine. That's what structural models are for. Ben Broadbent's talk is rather long, and not to be critical, I found it somewhat unsatisfactory because it goes back 300 years trying to sketch the correlations between fiscal deficits and inflation. But he never really says what they're going to do with the debt overhang. He simply says it was justified at the time, given the economic conditions, which is correct. It's simply a coincidence that we have easier monetary policy and a higher government deficit. Well, not really. And then he notes, of course, you need a credible policy regime. And his conclusion goes on for several paragraphs saying that we will not allow inflation to accelerate. We're committed to low, stable inflation, low, stable inflation, low, stable inflation, but never says what the solution to the problem is. And in that respect, I thought it was unsatisfactory. Having been at a central bank for 2.5 decades, central bankers do not go out and give talks on things that are not of interest to people. Someone has raised this issue, and they try and get ahead of the issue, ahead of the public discussion. So someone out there is concerned, and I assume brought to their attention, the role of monetizing the debt by the central bank. Continuing to talk much too long. So I did a call out before. Let me talk about the United States just for a second. This comes from the Congressional Budget Office. You can see the increase in the pandemic. There's the global financial crisis in here, and then the pandemic, and their projection is really quite startling because they see no primary budget surpluses anywhere in the future. If you look at their numbers, you go back and thinking, well, the real value of the debt, particularly when so much of this is now indexed as real debt, it depends on future primary surpluses or deficits. There aren't any. There aren't any surpluses. The last ones we saw were the Clinton administration before 2000. And as far as the eye can see, they continue to forecast primary budget deficits, which means, of course, you're borrowing not only for current expenditure, but you're borrowing to pay the interest on the previous borrowing. And you're doing this continuously, and the process is not sustainable. Now, the Congressional Budget Office doesn't say that in so many words, and the White House's Office of Management and Budget lives on a different planet, that they have primary surpluses projected out here based on 5% GDP growth and 1.5% cost of carry for the debt, I think is completely unrealistic. The unsustainability of debt, well, here's the Federal Reserve again. The Federal Reserve obviously supported markets and fiscal policy during the financial crisis by large-scale asset purchases. They had some runoff. They tightened policy, raising the federal funds rates, trying to taper off their balance sheet slightly. And then the second crisis, the pandemic, comes along. And the monetary liabilities, currency plus deposits of the Fed, suddenly jumped from less than $1 trillion to $5 trillion. Now, it's true, we're only talking trillions of dollars, but at some point, enough trillions really matters. And this has not gotten very much discussion. I showed this chart earlier, and given how long I've spoken, I'll quit with, I have some more, but I'll quit with this one, saying this type of process, when you see, not the same issues I emphasize, but when you see the Federal Reserve's purchase in the market, and they're calling it a large-scale asset purchases quantitative easing, and you see that very close to the size of the issues of the Fiscal Authority to finance the budget deficit, economists become quite worried. That worry is much more prominent, much more public, and much more discussion in the UK than it is in the United States. It's about time the United States started discussing the same issue, and all of these would have been very familiar to Professor Fry in developing countries, where we know this was such a problem for such a long time. It's just now exactly the same issues, the same techniques have come back to the developed countries after these two crises. And thank you very much for your patience. And thank you, Professor Black, for being here. I want to thank Paul Meisen and the Money Macro Finance Group, not only for being polite 30 years ago, but we brought Coles to Newcastle, but for doing much the second of Coles to Newcastle talk today Charlotte Bagwell for organizing the Zoom talk, Jane Binner, who I first met in 1994 in St. Louis at a conference I put on that we've had more than 25 years of productive interaction. And I should, again, call out to the late Peter Sinclair, who was involved in originally organizing this a year ago, but is no longer with us. Thank you very much. I'm going to go back to Jane. Let's see. Jane, I think you're muted, Jane.
We've got
There.
time for some quick questions. If there's anybody in the audience who's got anything, we've got another 5 minutes.
I see Alex's picture up here in the corner. If you're interested in this topic, Alex is a very fine paper in the BIS papers, what, 2012? That raises many of the same issues from their conference in Thailand in 2012. So the issues go around. I didn't attempt to do a review of the literature. And there's probably many people who said, why didn't you mention me? But I didn't even attempt that. I think a growth area in this is to expand on the DSG modeling, the computer modeling. There are a lot of issues. There's no textbook I'm aware of that does a particularly good job. Though Lindquist and Sargent's book on recursive macro modeling has discussions throughout it of government deficits, Riccardian equivalence, and similar issues. And I think that's a growth area for someone who wants to start modeling this more extensively. I'm going to go back to the DJT paper and try and understand better their modeling, their simulation model, and try and figure out some of the numbers that are in the table that were not correct in the original published paper. But it certainly seems to be an area, a good research area. These interactions, all this debt overhang, the interaction between the huge budget deficits and the central bank buying the debt in these developed economies is an issue that's not going to go away soon.
So I think we have a question from Alistair Milne from Loughborough. Alistair, would you like to?
I've just unmuted.
Hello.
Yeah, so a very nice and elegant and informative presentation, Richard. What was running through my mind, there's a lot of commentary in the UK press, people like Chris Giles, the FT, who talk about real interest rates are very low, interest rate nominal rates are very low, real interest rates are negative. This is the right time for the government to be doing lots of borrowing. There's no burden of repayment. How is that consistent with your analysis?
Well, the first question is, are you going to repay it? I mean, we say these are financial crises, and the government, as in the state of Texas, mobilizing savings. In many cases, no one ever asks if this has to be repaid. Right? It's true that real interest rates are low and inflation is low, but again, there's a circularity. They're low because they believe, as Ben Broadbent argued, that the central bank will do the right thing, that we will not see an increase in inflation, we will not permit an increase in inflation, et cetera, et cetera, et cetera. But is that realistic? The government budget constraint somewhere along the way is going to bind. If the costs of carry on the debt rise and the growth of GDP is not as high as predicted, as I said, in the United States, you can go to the White House, look at the Office of Management and Budget. They have primary budget surpluses, and they have debt to GDP ratios falling in their forecast. And then you go down Pennsylvania Avenue to the Congressional Budget Office, and they're the opposite. Who's telling the truth? Or more to the point, what's the risk involved? What happens if it goes badly? You now have debt burdens in these developed countries that we haven't seen since the Second World War. And we know, I mean, you go to British history, after the First World War, Winston Churchill was adamant that the debt was treated as real debt, and they stay on the gold standard and repay at the pre-war price of gold. We know that was not kind to British growth or aggregate demand. Right? That's just the way it was. After World War II, the UK and the United States inflated away much of the debt. You can't do that anymore. It's not nominal debt, it's real debt. If it's real debt, it's going to have to be paid in real primary surpluses. Cut expenditure or raise taxes. And no one wants to talk about that. So I think there's a problem, and we debated it a lot for years and years in the Federal Reserve about inferring from the market what's going to happen when the market is conditioned on what they think the policymakers are going to do. That circularity is sort of obvious in macro models, but it can be very dangerous in the real world. Others, complaints, shortcomings? I can't have done everything right. I don't usually. I can't possibly. And I know there's a great deal more literature. And I had originally many more quotations on the slides, but I kept cutting them, saying I can't possibly have time to do all that. You know, we have 2 minutes on my clock. Someone must have an interesting question. I mean, I think in the United States, the problem is going to become, if you look at CBO's projections and you say that the debt load under their projections is not sustainable, is what will eventually happen. I mean, I used to tell the students when that happens in countries, the government falls. The government's overthrown, right? The debt's repudiated, a new government. That isn't going to happen in the United States, I hope. That's the stuff of developing countries. There are investment advisors in the United States now strongly encouraging clients to convert retirement funds, 401k funds, into Roth IRAs, pay the taxes now because tax rates in the future are going to have to be much higher to handle this debt. I confess I haven't done that. I have a good friend who's a much more active investor than I have, who has engaged in that extensively, looking at the numbers, saying tax rates have to go up. It's better to pay them now than having to pay in the future when there may be a surtax, for example. We've done that before in the United States and put a surtax on top of the income tax. No one wants to talk about the long game.
I have a question, Dick, just by way of updating the work of Fry and Sinclair from 2002. Could you say a little bit more? You said there's a lot of fudginess and inaccuracy in the intersection, the equilibrium between the monetary and fiscal policy. Could you say how we've developed that in the interim with, for example, DSG models?
Well, I'm not sure I have a good answer for that. And they impose a reasonable equilibrium condition, right? That inflation is stable, and the bond, the debt to GDP ratio doesn't have to be zero. It just has to be constant. It can't be going up or down. And they argue that that position, given the simple equations they work with, is fairly fragile. Their interest essentially is in mapping out all the derivatives of that with respect to parameters, that system of differential equations. And what happens when you change the various parameters. I think today you'd put that in a larger computer simulation model. You wouldn't attempt to do that kind of differential analysis. It's an interesting experiment, certainly, and to see that it is a saddle ridge kind of property that has some instabilities, but I wouldn't pursue that any further.
So on that note, we've actually reached 1830 in the UK. I know we've got a lot of people here who've come in from the USA, I'm so proud to say. So it remains for me to thank everybody for coming this evening. It remains for me to thank Richard for a really stimulating, excellent lecture. I mean, given the importance of public sector debt financing, the Federal Reserve financing of deficit spending, the lecture is really timely and relevant. Really, it's absolutely a hot debate at the moment. You've brought forward a lot of issues that were outstanding from 2002. This is the first lecture in many years that we've actually had the privilege of having more Celia Fry here in attendance. We've actually got Caroline Fry coming in from the University of Hawaii. I've been asking Celia to bring along the family for many years, so this was a really excellent opportunity to do so. So we'd particularly like to thank the Fry family for joining us this evening. I'd like to join Dick in thanking COMIS and the MMF Society for all the support over the years for this lecture, and our people here in the University of Birmingham, Charlotte Bagwell, and those who worked very hard preparing the lecture. And Richard Black was so excellent in standing in today for Peter Sinclair. So we look forward to joining you again next year, hopefully in person. As I said to Dick recently, this is a lecture, it's about people. And it's just so sad that we had to do this virtually online, but I look forward to welcoming you all again next year and hopefully taking you for dinner as well in our excellent Edgbaston Park Hotel. So thank you very much for joining us. Thank you.
Thank you.